So let's have a quick breakdown of the operating expenses. We have our cost of goods sold. What was cost of goods sold? It was basically expenses which are directly associated with producing your products or service. What do I mean by that? Material, labor, electricity expenses of your factory. These are basically consisted of your cost of goods sold. The second one was your other operating expenses. Expenses that are associated with operations of your business, like your selling expenses, your marketing expenses, your general expenses of running, let's say, your office, your administrative expenses, salary of your staff. These are your other operating expenses. And what is the importance of this reduction? Why we are reducing the cost of goods sold and getting gross profit margin? And after that, why are we reducing our operating expenses to get operating margin? Very simple. The cost of goods sold deducting profit gives you gross profit. And if you have high GP, then your company profit will increase exponentially as your sales will grow. Remember, in our Excel example, we double the sales and our company profit doesn't increase double, it increases more than double. Why? Because our other operating expenses at one point of time, they don't grow as much as the increase in sales, because the operating expenses by the nature are usually fixed in nature and the cost of goods sold are variable in nature. So if the sales increase, the cost of goods sold increase usually by the same percentage, but the operating expenses almost remains the same. And that increases your operating profit and your net profit. So that's why the deduction is made. The second part is depreciation. So what is depreciation? Depreciation is a part of your operating expense. It basically means a percentage of assets which represents wear and tear in your assets like machinery, and basically serves a proxy for maintenance or replacement required for your machinery in the factory. Depreciation is a non-cash expense. What I mean by that, we will discuss it in length when it comes to cash flow statement. But right now, just understand depreciation just represent a proxy or an estimate of how much your machines have deteriorated during the period which we are looking at. Now, another simple side note, non-operating income should be viewed differently by you as a businessman. Why? Your focus should be how much you earned from your business, that is, your operating income. However, sometimes non-operating income shows income from your non-business activities. For example, like if you have surplus funds and you have invested it in a mutual fund and you receive dividend from the mutual fund, that will come under non-operating income. Now, of course, these non-operating incomes do increase your profit. But keep in mind, if your operating income is low and your non-operating income is very high, or the major portion of profit is coming from non-operating income, then you really need to think what business you are in, because the business or the operating income is actually low and the non-operating income is high. So whenever you're looking at your income statement, keep tab of your non-operating income. So let's summarize. Income statement in simple terms, what it told me. It told me how much my business made during a period. But how I taught you to look at income statement was very different at how usually you look at it. You look at the net income statement, you look at the income statement and you look at the net figure. I told you to look at income statement in 3 stages. The first stage is gross income. Gross income understands or denotes what? It basically denotes the scalability of your business, and it challenges the basic profitability nature of your business. What I mean by that is, if your gross income is high, that means the more you scale your business, the better your net income will increase, right? So that's why it's very important to understand what is the gross income of your business, to understand what kind of scalability your business possesses. Usually, a service company has very high gross income. A manufacturing company has a lower gross income than a service company, And a company which is just trading in goods, it has the lowest gross income of all the service or the manufacturing companies. So gross income tells you what kind of business you are actually doing and how scalable is your business. Next comes the operating income. And operating income tells you the operating results of your business. Basically, it tells you what is your business actually earning. For who? For you, that is the owner, and the people who have given debt to your company, people who have funded your business. So operating income belongs to you and the debt holders. And finally, we all know the net income. After non-operating income, and it comes after net income, which is calculated after adding the non-operating income, and it actually answers the question, first of all, what is the income which you have as a owner, and what is the real business you are in. For example, if the non-operating income is high, then you really have to understand which kind of business you are in. So all these income, gross, operating, net income, they each have a role to play, and each tell you something very important about your business and company. So I hope the next time when you look at the income statement, you don't just look at the bottom figure and move on. Analyze your income statement in these aspects, and you will understand a lot better about your business as you used to before.